Hi. This lesson has been put together to give you a basic understanding of what an option contract is. Over the next several minutes, I want to explain what an option contract is, who the types of participants are, why they are used in the markets, and how they can be an effective tool for you to use. An option contract is a derivative of something traded on an exchange. It is a derivative because its value is derived from an underlying such as a stock or share, commodity, futures, currency, or an index. They are extremely versatile as an investment or trading tool, but they do have a little more involved compared to, say, shares. Now, there is an exchange-traded option or ETO, and there is an over-the-counter option or OTC. Now, unless you're an institution or very large player in the markets, you'll be dealing with ETO or exchange-traded options. Now, these contracts are bought and sold through the exchange and with your broker. They are a completely legal investment tool managed and operated by regulated exchanges. Now, there are two types of options. We have a call option and we have a put option. Now, if you buy a call option, you have the right to buy shares based on the terms of the contract. If you buy a put option, you have the right to sell shares based on the terms of the contract. Now, both types of options have their own purposes. So what are the standardized terms of option contracts? As set out by the stock exchange, there are several key factors. Firstly, we have the underlying. I've mentioned this just a moment ago. An underlying might be a stock, a bond, a futures contract, an index, a commodity, or a currency. We also have an expiry date. Now, these expiry dates are set by the exchange. They might be weekly, monthly, quarterly, or a leap, which is a long-term option. Each option contract has a standardized number of shares that it represents. Now, the standard is for 100 shares per option contract. Next, we have the strike price. This is the price that the underlying will be transacted at on the expiry date. It's the price that shares will exchange hands. And finally, we have the option premium. Now, this is the price at which you would buy or sell the option contract. The value of the premium is derived from various factors, such as the current stock price, how much time is left until expiry, what volatility the option has, and there are a few other terms as well. This option premium is quoted through the options market. So who are the people who use or trade option contracts? And what are the reasons behind it? They are used by both institutions and private investors. Now, they will use them either in an investment capacity or they'll use them in a speculative nature. In either capacity, you could be a buyer or a seller of a call or a put option. And by that, I mean a buyer or seller as in the opening transaction. Now, for the option investor, there are two different types of investors. The first is for the long term or for accumulation of stock. So, for example, let's say that you believe XYZ company has the opportunity to grow in value over the next few years. Let's assume that you don't have the available funds to purchase the stock right now, although your expectations are that you may have that capital in the next 12 months or so. You could purchase a call option, which gives you the right to buy the shares with terms that are at the current share price on a contract that expires in 12 months. Now, it will cost you a deposit or the price of the premium. Now, with that premium, you don't get that premium back and it's not discounted from your final stock purchase value. So it's not quite a deposit, but it gives you the right to hold that option contract and the right to buy those shares at that set price on or before that expiry date. Now, our second example is for a risk management approach. Now, you might be concerned for one of the stocks in your portfolio, as your view is the company could have a difficult year or two ahead. So you may decide to purchase a put option. Now, this put option gives you the right to sell your shares at a set price anytime on or before the expiry date. By purchasing that put option, we can protect or insure our stock against a fall in value over the next year or two. And for the speculative trader, there are many different reasons why you might use option contracts. Firstly, by purchasing a call option, for example, you can speculate that the share price may rise. The premium of a call option will increase in value while the share price is rising. Vice versa, you can speculate that a share price might fall in value, and by purchasing a put option, the value of the put option will increase as the share price declines. Not only can you speculate the price might rise or fall, but you can speculate the price might remain range-bound or sideways. Option strategies can be used in bullish, bearish, or sideways markets. There are many different variations that can be adopted, providing the speculative trader with opportunities no matter what market conditions are present. Now, options are a leveraged instrument. To buy a call or a put option, you pay the premium value. Now, this is a portion of the value that the contract would be transacted at. That is, the strike price. If the stock price was, say, $30 and you paid $1 in premium to buy a call option, if that share price had risen, say, $3, with all other factors being equal, that would be a 10% gain in the share price, but a potential 300% gain in the underlying option. There are other factors to this valuation, but this is a very basic premise. Not only can the speculative trader benefit from directional movements in the underlying, but they can benefit from changes in market or even stock volatility and in what is referred to as time decay. See, options have an expiry date, so their valuation is affected by the dissipation of time. Next, let's have a quick explanation between the difference of a buyer or the seller of a call and a put option. So let's take a close look at the call option first. Now, if you are a buyer of a call option, you have the right but not the obligation to the terms of the contract. That is, it's your choice to exercise the right to buy shares. For this right, you pay a premium. Now, if you're a seller of a call option, you are obliged to sell your shares to the buyer of the option contract if that buyer decides to exercise the option. For this obligation, you will receive the premium that the call buyer pays. So why would someone want to sell an option? Well, there are many reasons why. First and foremost, it might be that the strategy they're implementing has a component of selling call options. There are many different combinations of strategies that require an option to be sold as an opening transaction. There are market makers who are also obliged to provide these contracts to the open market, so there is always a ready market for buyers and sellers. Now, for a put option, the buyer of a put option has the right but not the obligation to sell their shares. To buy that ability to sell their shares at a set price on or before a set date in the future, they pay a premium. And just like the seller of a call option, the put option seller receives that premium. But they are obliged to buy shares in the case of a put option. They'll be buying those shares from the put option buyer, only if the put option buyer exercises their right. As I mentioned, they'll receive the premium for that obligation. Now, for many beginners, this is one of the trickiest concepts to understand. So to line it all up, you can be a buyer of a call option, which gives you the right to buy shares, or you can be a seller of a call option, where you're obliged to sell shares to the buyer of the option. If you buy a put option, this gives you the right to sell shares. And if you're the seller of a put option, you're obliged to buy the shares from the buyer of the put option. Options are a sophisticated financial product. They're used to enhance or boost investment portfolios or to reduce risk during adverse economic environments. With a good knowledge of options, speculative traders can trade during any type of market conditions. They're not just resolved to buying stocks and waiting for them to rise in value. Now, with so many variations available, the trader can choose an approach that suits their personal financial makeup. If you're more conservative, you can adopt a conservative approach. Or if you're more aggressive in your trading, you can adopt a more speculative or aggressive approach. Now, the premium, or the cost to purchase the option, is much cheaper than buying the underlying stock, for example. And this can attract many investors or traders who have lower amounts of capital available for investing in the markets. Now, there are some terminology that I have not covered in this basic introduction, but you will need to learn these over time. First of all is at the money, near the money, or in the money. This is in reference to where the stock price is in relation to the strike price of the option contract. I also haven't touched on option Greeks. Now, this is part of the option pricing theory. Understanding the Greeks provides us insight into opportunities with our strategies. Now, option pricing theory, whilst great to understand and know, isn't certainly a necessity in your decision-making process. Today, broking platforms and trading software provide us with all the pricing theory tools. And finally, there are many different option strategies available. This can become a little bit daunting for a beginner, so start off with some basic strategies and build into the more complex strategies. If you'd like to learn more about options, you can visit MatthewBrownMentoring.com, where you'll be able to find more information about options and the various strategies that you can implement.